Good evening, everyone. This is Mark from RightLineTrading. I appreciate your coming this evening. I wanted to talk about 4 special indicators that we have, and just start off by giving you a little bit of background about myself. I'm a graduate of the University of Pennsylvania and a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years, and I began trading the futures and forex markets about 10 years ago. And I've been involved in the optimization of software systems for the last 10 years via mathematical modeling. And that's really how our software developed. We looked upon the prediction of future price movement as the end result of an interaction of multiple independent variables, and then we place the independent variables into an equation, and then optimize them mathematically, and that really is the way that RightLineTrading was born. Now, I just wanted to talk about one of the reasons why there are so many problems today in day trading. Now, it's a very precise business, but you really have to start off with the right tools. And a lot of the indicator combinations that are out there right now simply don't work. And a lot of people choose to use an oscillator with Renko bars. The stochastic is one type of oscillator. There's also relative strength. There's the CCI. There are others, Williams K. But they're all momentum indicators that show the location of the close relative to the high-low range over a set number of periods. And what they do is they require 4 numbers to be placed into an equation in order to trace out an appropriate %K or %K line. You need the open, the high, the low, and the close of each candle formation. Now here's a stochastic chart, and here you can see a %K tracing out appropriately. And each of the formations, which in this case is a candle, has a high, a low, and an open and a close. So this stochastic line works. But if you place that onto a chart that has Renko bars, you can see it's missing 2 of the digits. There's a high and a low, but there's no open and close of each formation. So the gold %K line is not really tracing out a %K at all. All it's doing is just mimicking price. So you have to be extremely careful over what indicator combinations you do use in order to increase the positive predictive value of getting a successful trade. And the positive predictive value consists of sensitivity over specificity times prevalence. And you know that what we advocate is trading with a tremendous amount of specificity. You only want to take trades where all of the independent variables that you require for a trade are aligned, and you want to make the market, you want to wait for the market to come to you. Now, as far as the oscillator is concerned, what we did is we looked at, does it in any way increase the precision of our trading? The oscillator signals actually work. And what we found was that the oscillator is traded in 2 different ways by 2 groups of people. One group of people use an overbought signal on the oscillator as a marker of bulls being firmly in control of the market. And what they do is they continue to buy each higher pivot as long as the market remains overbought. And so they go long. Another group look for divergence on the oscillator. They look for a price to make a higher high, and in this case it's RSI, a relative strength to make a lower high, and then they fade the market for a reversal. So we both know how accurate that is. It's not particularly accurate. A lot of times you're going to get run over. But the question is which group of traders is right? Do you wait for an oscillator to make a divergence signal and then take the market in the opposite direction? Or do you simply continue to buy long as the market continues to go up? And what we did was we put that into a year of market replay data. We ran it and determined what the positive predictive value of an entry is if you use the addition of the oscillator signal. And what we found is that the oscillator doesn't really make much of a difference at all. That really both groups of traders are right and both groups of traders are wrong. And that if you use the oscillator to try to increase the precision of your trading entry, it's not going to make any difference at all. All it's doing is using data from your trading chart, and that it's impossible for that data to provide you with a forward looking prediction. Price is driving the indicator. The indicator is not driving price. We looked at Fibonacci as well. And Fibonacci was a mathematician who lived in the 17th century. And when he was around, he created a Fibonacci transformations. And Fibonacci transformations, they developed Fibonacci numbers, and Fibonacci extensions, and Fibonacci retracements. And what we've learned since then is that Fibonacci numbers really don't describe very much in nature. They describe the number of edges on a pine cone, and the number of ridges, and also the number of edges on a snowflake. They really don't have much role in describing the interaction of particles in the closed system. And some bright guy got the idea of applying Fibonacci to the stock market, and why someone would think that Fibonacci numbers would in any way predict the future price movement of stock, I don't know. But what we did was we did the same thing. We took a year of market replay data and looked at whether or not Fibonacci numbers or Fibonacci levels held or broke. And what we found was that was so inconsistent that Fibonacci also in no way increased the positive predictive value of a trade. If you used a fib level to try to predict future price movement, the movement of price at a fib level was so erratic that it just simply didn't increase or help in any way determine future price movement. So these are indicators that we've discussed, and essentially, to put it into a nutshell, 95% of day traders fail, and that number never seems to get better. The generation of day traders that are around today are about as likely to succeed as a generation of day traders around 10 years ago. And the question is, why is that so? If each generation of day trader learned from the previous generation, then the number or the percentage of day traders that are successful should slowly approach 50%. Now, it would mean that 50% of day traders are successful against other day traders, and these are commercial day traders. And both those groups having an equal chance to win or lose against the big commercial firms. So that number should really approach 50%. and yet it sits at 95%. And the reason that's so is because no generation of day trader learns from the previous generation. It's the same principles: Fibonacci, the oscillator, even the MACD. Every single generation uses the same basic core methodology that the previous generation in order to try to trade. And they never correct the mistakes. And really, there are only 5 parameters on a trading chart that can be assessed by any indicator using any formula. And that's the high, low, open and close of a formation, and volume. And there seem to be new ways to package it, to word it, and unfortunately, it comes with the same value each and every time. So the predictive value of any indicator that assimilates data from your trading chart only is extremely limited and is not really going to be of any value whatsoever. So what we did was we went about to try to develop a set of indicators that really do increase the precision of your trading. And I'm going to show you a set of those indicators. Today we're going to look at 4 of those, and you're going to see why they are so powerful in determining exactly trading entries. Just 1 second here, and I'm going to change the screen. It's just price. Now, the first I'm going to talk about is market profile. Now, for those of you that are not familiar with market profile, this is the value area high. This is the value area low. And this is the point of control. I just want to do one more thing. I want to show you. Normally we don't project it, but I want to project it this time. Just excuse me for 1 second. 1 second. Okay, excuse me. So you can see there's a histogram here on the left edge. And this histogram is all volume at price. Now the point of control describes the histogram bar that has the most volume. So in this particular case right here, crude oil, traders like crude oil at $42.77 greater than at any other price. Now, the area between the value area low and the value area high describe a certain amount of volume at price. And what they describe is a bell-shaped curve. It's not exactly a bell shape. but approximately 66 2/3 of all volume at price is between the value area low and the value area high. Now, this is something that all market profiles set out to do. But what we found was that almost all market profiles are not optimized. And here's the problem with most of them. Now, first of all, you can see how price respects the value area high. These are really, really powerful areas of support and resistance. This 66 2/3% is described as fair value. This is where the bell-shaped curve is. This is where 66 2/3% of all volume crosses. And so we look at the price in between the value area high and the value area low as actually fair value for whatever instrument you're trading. So price wants to stay in that fair value zone. So when it approaches the value area high is going to act as a strong area of resistance. When it approaches the value area low, it's going to act as a strong area of support. The point of control, where most volume is at any given price, is also going to be a strong area of support and resistance. I know it's dynamic and continues to create powerful areas of support and resistance throughout the trading day. Now, there are a couple of things that are deficient in most of the market profiles. Number one, they assimilate data and project it at candle close. The R indicator creates the value area high, value area low, and point of control, in which everything is modified intra-candle. Now, the reason that's so important is, let's say you take a trade at candle close, and the market profile is moving only at candle close. The market profile can jump right in front of your trade and create what was a great trade when you took it into a trade that's really got a high probability of losing. You don't want market profile to jump in front of your trade at the end of a candle, and it won't if it assimilates data intra-candle. And as far as I know, this is the only market profile that does intra-candle analysis. Two, is the look-back period. Now, market profile can be modified to look back, to create a market profile based on 1 day of data, based on 5 days of data, and you'll see other platforms where they'll have a histogram that's 1 day, 5 days, a month. They have multiple histograms that create multiple market profiles based on the time period. And that's very cumbersome to use. It's very difficult. So what we did was, we didn't want our market profile to only look back 1 day. Because if it looks back and assimilates all the data that's accumulating over the course of the trading day, at the beginning of any trading session, the value area high, low, and point of control are going to get pushed around very rapidly, because there's very little volume at any given price. So even though the point of control is still looking at the histogram bar that has the greatest volume, there's not very much volume crossed for a significant period of time during the course of the session. So you can see that the value area high, value area low are going to be too nimble. They're going to be moving around too quickly, and they're going to get pushed around by by moving price too quickly. So what we did was we set a proprietary look-back period. I can't tell you what that period is, but our market profile looks back a set number of days. So when you open the day and start the trading session, you have a market profile that's stable, will not be pushed around by any moderate fluctuation in price, but it's also still nimble enough to move around to provide you with very accurate areas, very accurate value area highs, lows, and point of control. And that is really, really important. And the third is, we looked at a whole bunch of open source market profiles. Now, in general, the distance between the value area high and the value area low is 66 2/3%. But what we found is that different market profiles actually created this distance between 67 2/3% and 70%. And the distance made a tremendous difference in the predictive value of the lines. So what we did was, again, set about to determine what is the optimum space between the value area high and the value area low. Is it 67 2/3% or exactly 2 standard deviations between here and here, or one standard deviation from the midpoint, or is it closer to 70%? And we found that it's somewhere in between. And again, we did that with optimization procedures. We have a program for that. We do a 2-year look-back period. And so what we have is a proprietary space between the VAH and the VAL. And that really increases the power of support and resistance at the value area high and value area low. And I didn't pick this. I didn't pick this area. We can go through the chart. This is crude, but you can see how crude respects the value area high and how crude respects the value area low. It doesn't want to move above it, and it doesn't want to push through it to the downside. So that for the most part, it acts as a great indicator that creates very powerful areas of support and resistance. If we move through today, now, because our market profile is dynamic and moves intra-candle, the only place it's accurate is on the right edge of the chart. You've got to move price to the right edge because the value area high and value area low are constantly moving. So when price on the right edge, you see price break to the downside and then come back to retest the point of control. Now, if the point of control is really a tough area of resistance to the upside, you can take a short at the close of this candle to the downside and price falls. And I was going to try not to move it, but the same thing happens here. It hits a powerful area of support and turns. You're going to enter one tick above the close and price goes up. And the way you can see that is by moving price off the right edge. And you can see how it went down up to the point of control, down to the value area low. Now it's gone back up to the value area high. In this case, it broke it. Now, I don't want to get into trading techniques, but what you need to call a reversal is a candle that has enough power to give you a dark cloud cover here in terms of price action. So this would not be a reversal candle. But this is a dark cloud cover. This is an engulfing candle. This is not quite a piercing candle. But you can see how well it predicts price movement. So this is one of our indicators. I don't know, I can't remember how much it's normally, but for all the indicators individually, we're only charging $99 today. So now let me move to the next indicator. And the next indicator is extremely unique. Now, for some reason, our hold on one second here. I have to change our dashboard is connected to our FX data feed, and I want to connect it. To our excuse me one second here. Okay, here we go. Let's look at the E-mini. Now, for each market, we have a different quant line. And this is the ES quant line. ES quant lines. And these are the E-mini quant lines. And I have to change this to a 5-range E-mini. Let me dial in the ES. All right, now what quant lines do? We call it our quantitative analysis indicator because the correlative markets inside each of these lines are quantitatively weighted based on the correlation coefficient of the market. And I'll explain that to you. We know that when, let's take today was a pretty flat day on the E-mini. Let's go back a few days. Okay, this is a good period right here, actually. Now we know that when the E-mini, now I've traded the E-mini for many, many years, and I have never had a tool as powerful as our quant lines. These quant analysis lines really work hard to incredibly increase your precision on trading the E-mini. Now, they can't be taken as a standalone signal to go long or short. But when you get a trading entry and you have the quant lines aligned in your direction, you're going to take a trade that has a markedly increased chance of being successful. Now, we know that when the E-mini goes up, certain other markets go up with it. One of those markets is going to be the Russell. Another market is going to be the NASDAQ. Now, the Russell and the NASDAQ always go up when the E-mini goes up. But what they do is they go up when the E-mini goes up, at least with a correlation of 0.7 or 70%. So 70% of the time, when the E-mini goes up, the Russell and the NASDAQ are going to go up. Now, when the E-mini goes up, we know that certain markets are going to go down. And they're going to go down 70% of the time or greater. Two of those markets are Treasury notes and bonds. Now, they don't correlate 100% of the time, but they correlate at least 70% of the time. So what we did was we looked at all the markets that a correlation coefficient of 0.7 or greater, either in the direction of the E-mini or in the opposite direction of the E-mini, and came up with 9 markets, of which I can't really tell you what they are because it took us months to find them. And 3 of them are in each of these lines. 3 markets in line 1, 3 markets in line 2, and 3 markets in line 3. Now, you know that what happens in the course of a trading day is that institutions rotate their money. You get money rotation. When risk is on, they're gonna put their money into bonds. They're gonna put their money into stocks. When risk is off, they're gonna go into notes, into bonds, into precious metals, into certain currencies. So if you look at the market in the course of a day as really simply the rotate, and in a perfect market, that's exactly the way it would be. There's no money inflow and no money outflow, and that's really the way it can be looked at. It's that there's a fixed number of dollars in the market at the start of every day, and there's that same fixed number at the end of the day. What really happens is the big institutional guys are going to rotate that money depending upon their assessment of risk. And so what the quant lines do is track that money flow, because what they're looking at is correlative markets. Now, when the E-mini goes up, and the markets that should go up 70% of the time do go up, and the markets that should fall 70% of the time when the E-mini goes up fall, then the quant line is going to turn green. It's going to tell you that money is flowing into the E-mini and its correlative long markets and falling and moving out of correlative markets that go down. So if you wait for at least 2 of the lines, the first quant is really the dominant line. It's got the most important markets. And so you're looking for the first line and either the second or the third line. Now, there are times when you're going to get all 3. And when you get all 3, you're going to really get a stellar trade. You just wait for a perfect entry. But you can see once that first quant line, the major quant line, went green, and the second quant line went green, which is really here, price is going to be heading up. Now, price is not heading, the lines are not green because price is heading up. Price is heading up because the quant lines are green. These indicators are not looking at price on this trading chart. They don't care what the direction or what's going on with the actual E-mini. They're looking at other correlative markets. So you can see how well a dual green quant predicts a move to the upside. And if we look here, now here for a brief period of time we've got 2 reds, and for the period of time here we only have 1 red. But if we look here, when we have the first and third red, you want at least 2 lines red. Doesn't happen often, but when you get it, and it occurs right here, the E-mini is almost always going to fall. So you're going to look for a trading short in this scenario. When the quant lines are yellow and all the correlative markets are moving in opposite directions, then the E-mini is most likely going to go into a period of chop and be difficult to trade. So if you're looking for an indicator that can markedly increase the predictive value of an entry, this is a superlative indicator. And I mean, I could spend the whole day going through it, but it's very difficult for the E-mini to go long without its correlative markets moving long as well, that are supposed to go up, and the correlative markets that are supposed to go down, And you see you have two quants here. The weakest quant's the middle. If you have the first and the third, you're cooking. And here you go for a really beautiful move to the upside. Now, this isn't going to catch every single move, because the correlation coefficient between these markets ranges from 70% to 90%. But when they do align, you are very likely to get a good trade. Now remember, right here, you only have one quant. A brief period here, you have two. You want to wait for two, and in this case, three. But we have no price structure. We don't know if we're overbought, oversold, but you're definitely going to get a move down. And this huge move down here didn't recruit three quants until very late in the move. And sometimes that happens. Like I said, it's not going to give you every single move. But when they align, you're very likely going to get a move that's extremely powerful. You can take a trade without them, but if you do, you're definitely going to increase your risk. Here's another one right here. Goes green, green, right on this candle, right here. Now, I will not take a trade on the E-mini unless I get two quant lines aligned in the direction of my trade. And sometimes I'm going to miss trades. When you trade with specificity, you sometimes are going to miss winning trades, but what you're going to do is you're going to avoid the losers. And we want to trade with specificity. Now, the quant line is different for every single market because the correlative markets are different. And if you look, we have, here are our quants for the Forex. And here are the quants. There's another Forex market. We have the 6E. We have crude. We have the E-mini. We have the DAX. We have gold. We have heating oil, natural gas, the NASDAQ. We have silver. Here's our stock quant line. Here's the Russell quant line, the YM quant line, bonds, notes, and here are two more futures markets. Each market requires an assessment of multiple correlative markets. So each quant line, each chart has to have its own individual quant line. Now, some markets have a lot of correlative markets. YM has 9, bonds has 6, notes has 6, stocks have 9, gold and crude and 6E only have 3. So the number of quant lines you get with the indicator depends upon the number of correlative markets we could find for each of the instruments you're trading, and so it's going to vary. Now, the most powerful quant indicator are the ones that we were able to find 9 markets or 6 markets. But even the ones where we have one quant line, if you trade with the direction of the quant green on a long, you're markedly going to increase the predictive value of a long trade, and you definitely never want to take a short trade. That's the other thing it tells you, and that is don't trade against a dual quant green. Don't try to go short, and don't try to go long when 2 quant lines are red. You're going to have a lot of trouble getting a trade in that type of environment. So that's how helpful these quants are. And again, today it's $99, and normally I think they're $249. Now the third indicator I want to show you, which is also very unique and incredibly helpful to trading, is our bias indicator. Now the thing you're going to notice about our bias indicator is that, again, it does not utilize anything, any movement of price on our trading chart. We don't use indicators that assimilate data from our trading chart. And what bias does, and this is a fractal indicator, so every time I move it, I'm going to have to refresh the chart. Let me go back to crude, because I think it's going to show a little bit more volatility and make it a little bit more easy, make it a little easier to see the utility of the of background bias. I'm just going to remove all of the drawing objects. Okay, now what background bias does is it looks at the direction of the market on 2 higher time frames. It doesn't look at anything that has to do with price on your trading chart. We believe that indicators like that are useless. So what this does is tell you, and let me just make sure that it's projecting data that's correct. What it tells you when the background bias is green is that your 2 higher time frames are moving to the upside. And on a green, it tells you that all resistance is broken to the upside on those 2 higher time frames. So green is a powerful uptrending color. And again, price on crude is not turning the background bias green because your 2 higher time frames are moving to the upside. Price on your trading chart is going to have a strong tendency to move in the direction of your 2 higher time frames, which is up. Let me refresh it. Now this is a little bit of a weaker down signal. I'm sorry, right here. But it's still telling you that you want to take a short trade. In this particular case, the 15 has not crossed the 50 on your higher time frames. We want the 15 to have crossed the 50 on the higher time frames to give you the pink. Here, the 15 is above the 50 on a short, and all support to the downside has not been broken. But there's still a strong tendency for this color to give you a down draft on price. Now you can see, even on this pink, there's a little bit of a tendency to go down, but you don't get a gigantic move. You need a good trading entry. And this indicator is appropriately titled bias. In which direction should your bias be in taking a trade? When it's this teal color or it's pink, your bias is to take a short trade. That's what's going to give you the winning trade. Trades to the upside are going to be associated with a much greater failure rate than trades to the downside, because you want to trade in the direction of the 2 higher time frames on your chart. Now the blue color tells you that all resistance to the upside is broken, But we have a 15-day proprietary, and our 50 are flat. So there's a very mild bias to the upside, mild, and you still would be very difficult to take a short trade here. But neither the 50 or the 15 are trending. What they're telling you is price now sits above all resistance, and it's just floating there in a trendless market. So you would be very, very careful about taking a short or a long on a blue color. Now let me just refresh. You can see what happens here. 2 time frames are aligned to the upside, and look at the size of that move. Now you can't take it, this doesn't give you precise trading entries. What it does is create a bias for you. Whatever system you're using to give you an exact entry, whatever methodology you trade, that's going to give you your exact entry. This is going to give you the bias that you want to be associated with that entry. Now, if you don't trade in the direction of your 2 higher time frames, you're going to have a lot of trouble. And without having to look at your 2 higher time frames, now on a tick chart and on a range chart and on a Renko, the 2 higher time frames consist of the higher fib numbers. So on an 8 range, our 2 higher time frames are 13 range and 21 range. If you're trading a 377 tick, I think your next highest time frame, I think, is 650. I can't remember these fibs. And then the next fib after that, 900 something, I think, or right around that level. And the bias indicator automatically sets these higher time frames simply by looking at either the time frame, the tick number, the range number, or the Renko number you've chosen to trade as your trading chart. It does it automatically. If you're trading a number that's in between a fib, it's going to default to the nearest fib and then give you the 2 higher fib time frames. So that's how important this indicator is. If you trade without any background bias, it means that the time frames are all misaligned. One longer time frame is trading up, one is trading down. The 15 and the 50 are all jumbled on each other, and it's much, much more difficult to get a successful trade when there's no background bias. Now you can see that they happen, but again, we're looking to trade with specificity. And what happened here was this: it's 9:30 and the open of the E-mini. And even though the E-mini doesn't necessarily create a change in price with crude, after trading the number of years that I have, it sometimes does. And right at the open of the E-mini, price just skyrocketed. So you have to watch at the open of a major market like the ES and stand aside on crude, because crude could take an abrupt change in direction. And here's another. But really the bias really starts right here. So you really want to trade in the direction of bias. All upside. And this indicator never fails to give you the appropriate bias or direction that you should take a trade. So if you're looking to increase precision, this is a really terrific indicator to use. Again, this indicator is $99 today. Now let me remove the drawing objects, and we're going to go to the last indicator. The last indicator is we have what's called a 3-line indicator. And essentially, we've pretty much removed all the lines. And all we do right now with the 3-line, well, for some reason, they're coming up. All right, if you hang on 1 second, I'll fix it. If we don't want to look at those, I'm just going to put an 8-range template in. And I'm going to knock out everything except the 3-line. Sorry, I didn't see it. 1 sec. Here it is. Okay. Now, let me take out everything except the 3-line. Now, here's the 3-line indicator. Now, there's a lot of different ways that you can project order flow. And this is really an order flow indicator. Now, order flow is a really helpful independent variable for increasing the precision of your trading entries. Now, again, we use the same principle that we do for almost all of the indicators on RightLine. This order flow indicator is not assessing order flow from anything that's taking place on your trading chart. It's assessing order flow from your 2 higher time frames. And what it's looking for on each candle is determining whether there is an excess of executed buy orders with compared to the previous candle, or an excess of executed sell orders when compared to the previous candle. And it has to occur on both higher time frames. There has to be an alignment. Now, when that alignment occurs, what you get is these candles outlined in blue or green. Whoops, it doesn't matter what color they're outlined in. I didn't fix it, so they're all outlined in one color. And that tells you that order flow is aligned to the upside. And you can see when you get order flow aligned to the upside on these up candles, the strong predisposition there is for price to move up. And the order flow alignment is taking place on the 2 higher time frames. Now, there are lots of ways to display order flow. I'm sure a lot of you have seen the footprint. Oops. And the numerous other ways that you can display order flow. The problem with the footprint and the problem with all the other ways that order flow is displayed is that it's using data from your trading chart. And it's my personal belief, based on all the information that we've used here at RightLine and all the analysis that we've done, the footprint is great for telling you what is happening, but it's not great for telling you what's going to happen. It doesn't have any look forward potential. And it really does do a great job of telling you why the market is going up now. But it doesn't tell you anything about what the market is going to do on the next candle. It has no predictive power. It does create tiny areas of support and resistance, which I think are very minor and of little importance. So what we do is we look at order flow alignment to the upside or to the downside on our multiple higher time frames. You can see here's a move to the downside. Order flow kicks into the downside right here. Here it kicks into the upside right here. And it actually stays with the trade all the way to the top. Here, order flow all the way to the bottom. Now, price is not order. You're not getting the candle surrounded in yellow or red or blue or green because price is falling. Price is falling because order flow is aligned to the downside on your two higher time frames. This truly has future predictive value because it's looking out ahead into those future time frames. So now, if you have these four indicators telling you what's going to happen into the future, one is the bias indicator, looking at two higher time frames on support and resistance and market direction. You have order flow, looking at your two higher time frames, the alignment of order flow, excess executed buys, excess executed sells. You have the quant lines, which I think is one of the best indicators I've ever seen. And you have market profile, tracing out areas of support and resistance. No matter what system you're using, one or a combination are going to markedly increase the precision of your trading entries and make you a more profitable trader. Now, if you're not trading profitably, this may give you the edge that you need to trade profitably. If you make money trading almost every day, these are very, very likely to push you over the top. Now let me just quickly, because I want to answer any questions, show you really quickly what the chart looks like with these four indicators in it all at the same time. Let me just load the template. And now let's remove the indicators that we're not looking at. I'm going to leave the moving average colored in there. And I'm going to leave our 15. Now you have a chart with all four of these indicators combined. Now, when you're trading above, let's go on to the right edge, because this is really where you're looking for an entry. When you're trading above the 50 and the proprietary 15 and sitting right on the point of control, acting as a strong area of support, and the candles outline order flow and momentum, you have a long trade. Now, depending upon your ATM strategy, you'll get a piece of this move or all of the move, depending upon how much risk you want to take. Now, you have no background bias at all. And you can see you have a weak downtrend here at 6 o'clock in the morning. And here's the open that I showed you of the E-mini. And there's really nothing here. But here's your trade. You have the move up. You have the retracement to dual support. of the value area high and the modified 15. The candle is outlined with order flow and momentum. So you're sitting right on top of tremendous support. You know your two higher time frames are moving to the upside. You know that all resistance to the upside is broken. You're in one tick above the close of the candle, and you got a long move. And you got a really, really nice trade on crude. Depending upon your ATM, you can go from up to here, or you can go up to here. The one thing that you know is you're not going to take any of this to the short side without a doubt. At least if you don't get the long trade, which you should get, you're not going to take a short trade and try to trade against your two higher time frames, because that is a penchant for disaster. And if you look at the trade, depending on your ATM, this entry could have gotten you all the way to here. Now you would have to have a very loose trailing stop on that last contract, or however you choose to trade, in order to take this all the way up before it goes out. That's a rough trade to take. But you can see, as long as you have long bias, as long as you're trading above the modified in the 50, as long as you're trading above the value area high, which acted as the last area of major resistance to the upside on your trading chart, you know the background, you've broken upside resistance on your two higher time frames. There's a strong predilection for the market to rise. Now, I don't have the quant line in here for some reason. I'll put it in for 2 seconds and then I'll stop for questions. Let me just find the crude quant. Remember, you want to trade with the quant as well. And right here is where the quant goes green. So when you've got all of this, you're going to look for some retracement to support to take long. If you get stopped out, you're in again here. If you get stopped out, you're in again here. Every pullback to support, as long as the 15 stays green and the 50 is green and the quant line is with you, you're in this trade. And here the quant line turns yellow, which tells you that the correlative markets have weakened. Background bias weakens. It tells you you're above support, but you don't have a trend anymore to the upside, and you can see the market rolls. Now, this is upside bias. And we're just getting a lot of chop here. And I wouldn't take any of these trades. We're trading. This entry would put you right into the value area high. And here's the trade. You go down, you trace right back to dual resistance of the point of control and the modified 15, and there's your entry candle short, right here. You're looking for a retracement into a confirmed trend, and down you go. I mean, that's a very, very lucrative move. If you take it all the way, it's 23 ticks. Based on our ATM, that's a $400 trade. So this is when you combine all of them, each of them incrementally increases the precision of your trading. If you wait for all of them to align, if you wait for the 50 to be red, the 15 to be red, order flow in your favor, you stay out of the way of the market profile, support and resistance. In this particular case, you use market profile to trade off of as an area of resistance. You wait for the quant line to be red, you're going to really, really see a marked improvement in the way you trade. It doesn't matter what system you use to give you your entry. We take a pullback to resistance on a short trade and a pullback to support on a long trade in a confirmed trend to take a trade. And that's how we trade. So Each of the indicators, these four, background bias, the quant line, order flow, and market profile, are 9 hours today. And I think it extends through tomorrow. So let me just see if there are any questions. 1 second here. Okay, very few. Yes, we are, Sam. We continually work on the quant lines, continually, and we tweak them all the time, because it's a very, very good point. The correlative markets, if the correlation coefficient falls less than 0.7, then we have to remove it from the market. We have to remove it from the quant line. So we're about every 2 or 3 months, every quarter, we rerun 2 years of market replay data to recheck the correlation coefficient of all the markets we use. And we use an enormous number of markets. We actually have agriculturals. We have all the precious metals. We have many, many currencies. All of the index equities, the Dow, the NASDAQ, the Russell, and the E-mini S&P, and many other markets. So we have to check that correlation coefficient constantly. And remember, in the quant line, they're weighted based on the degree of correlation. If one market correlates 90% of the time, and one market correlates 70% of the time, then it's given a higher quantitative weighting. So we have to constantly tweak the quantitative weighting of the markets within a quant line to give it as much power as it has. And we do that all the time. It doesn't take us more than a week to run 2 years of market replay data at 500 speed on all the markets that we need to. So we accumulate the data pretty quickly. The quant is right here. This red line and yellow line and green. On crude, we could only find 3 correlative markets. So we could not do more than 1 quant line. Some markets have 1, some have 2, some have 3. You can see the power of this entry here. Now, if you took the entry here, you would not have gotten stopped out. But this is a more powerful background. And this occurs intra-candle. Remember, on this background, the market on the higher time frames isn't trending. On this, it is now trending. So this is a better trading entry. But if you jump the gun and got in here, you'd just be given some heat. You've got the quant line with you. The background bias is an appropriate color. Either way, you're going to get that move up from here or from here. Now, right now, we're only on Ninja, unfortunately. You should have sound. Somebody said there's no sound, but you should have it. Is everybody okay with sound? Okay, great. Thank you, Mark. Thank you, guys. I think it's just you, Larry. Everybody else has got sound. The minimum deposit to trade on Ninja, if you want to trade 4 contracts, Arthur, is about $5,500 to $6,000. If you want to trade 2, yeah, the best thing to do is reboot, Larry. If you just, but I think Larry's got his sound back. I hope. Want to trade 2 contracts, which is also profitable, then you're going to need about $3,000, $2,500 to give you a little bit of leeway. We trade 4, but 2 will give you a very profitable. We can give you a very profitable ATM strategy, which will tell you. And we do all the setup here. This takes a lot of work to configure on your Ninja platform, I mean, our tech support guys are unbelievably good. So they'll configure everything. Now, we have people that trade minute bars, 3-minute, 5-minute, 15-minute, 4-hour. They trade daily bars. Not everybody who uses these indicators even day trades. A lot of them swing trade. It's great on stocks. I didn't project stocks up because I didn't want to move to the stock data feed. But if you're trading options on stocks and you want to determine a stock direction, and you want to trade, say, a 35 tick, or you want to trade 4-hour bars, it's going to give you a tremendous assessment of the direction that the stock is going to go in. That's one of the things I'm going to talk about on Thursday when we have a webinar on trading options. The weakest thing that these options gurus have is they have very weak software to predict future market direction in terms of stocks. Our stock quant line is extremely powerful. It works a little bit differently than the futures does, but it's still very predictive, and it helps increase the precision of the trades. So, we're going to talk about it then. But right now, we will have Sierra charts up and running in about a month. We're not that far away, but because these indicators are fractal and they're all assimilating data from higher time frames, creating a new platform on a different charting program is hard. So we've been working on Sierra a while, but we should have it done within the next 4 weeks. It does, Arthur. It does. It allows you to do that. So that's it. If there are any other questions, you feel free to call us in the office. I'll put up our number. I mean, we're at www.RightLineTrading, and our number is right on the website. Now, all the indicators, again, are $99. And normally, the bias indicator, if you go to the website and you look at the prices, you're going to see the difference in price. Our number is, and the reason we're doing it, 855-765-6681, is we believe that if you buy one indicator, you buy 2 indicators, and you really see how well they work, we feel that you're going to want the platform. And let me just show you quickly. Here's the website. And if you go to all our products and you go to the order flow indicators 129, market profiles 129, bias is 299, and quant analysis is 499. Because, the quant analysis indicator is the one that created the most work for us. And it's really that for some reason this is duplicated here, and I have to tell our developers to get that off. But those are the normal prices, and they're going to go back to those normal prices after the end of tomorrow. But we really are giving a significant discount because we think the platform as in its entirety is extremely powerful for day trading. And that's really what we want you to expose you to, not indicators acquiring data from your time frames, from the charting time frame, from your higher time frames, and doing it in a way that's projected onto your trading chart that makes it very easy to interpret, very easy to read, and markedly increases the precision of your trading. No, it's $99 for each, not for all 4. Normally our quant analysis is $499, and we sell a significant number of them at $499. The bias our background bias is $299. Our market profile is $129, and our order flow is $129. So we're at $99 for all of these, but each individual $199. Now, if you're interested in buying all 4, give Rory a call, and maybe he'll give you a little bit of a deal on all 4 indicators. But if you want to buy 2 or 3 of them at $99, there's still really a tremendous discount. So listen, everyone, if there's any other questions, just give us a call or send us an email. I'm very, very confident they're going to help your trading. And I'm telling you, you're going to become addicted. once you see how well utilizing data from your 2 higher time frames becomes in terms of your trading, you're just not going to want to be without them. And you can do the same thing on your own. Set up 2 other charts, look at 3 charts at the same time, look at support and resistance at the same time on 3 charts, and you'll recreate the bias indicator. Market profile you cannot, because the parameters that we have are proprietary and unique. It's the same thing with order flow. And the quants were I don't know any other company that has created correlative markets that are so easy to interpret and so easy. And you can see how the correlative markets so well correlate with that area of the bias indicator in which it is so likely for the price to go up. And remember that this line is assessing totally different data than the background bias, completely different. And yet they match with a high degree, because everything is looking at other markets, other time frames. And as soon as you get, this is a little bit of a weaker down color, the quant lines kick in, because those quantitative markets are telling you the money is flowing out of crude, and the predisposition is to take it to short. These don't contradict each other, except once in a blue moon, the correlative markets won't. And here's the upside. And when that quant kicks in, it kicks in before background bias does. All you do is watch the quant and watch that background bias to get to the more powerful color, the cyan or the dark green. And this is where your move to the upside is going to be very, very powerful, because your quant line can be a leading indicator as well. Sometimes it lags and sometimes it leads, because it's assimilating completely different data than what's on your trading chart. So that's it. I hope everybody learned something at least. If you don't buy anything, we really wish, I mean, that you were a profitable trader and you do really well. It's very tough. Remember, we can only beat the other commercial traders. We cannot beat the institutional traders. Out of 100 commercial traders like us, we want to beat 95% of them and become profitable and make money on a regular basis. And I really am telling you, these indicators will help you do it. They're counter-trend trading. They're trading against the direction of the correlative markets, trading against the direction of the 2 higher time frames. They're taking trades that we exploit. And remember one other thing, and then I'm going to really finish. By traders going short here in this candle, they help us, because when we go long here at the close of this candle, this is going to move up with 2 forces. One, the addition of new buyers, but also stopping out everybody in this down candle. These traders in this candle are all going to lose. And as they get stopped out, it's going to really help. It creates a little bit of a short squeeze, and the market's going to power up on that short squeeze. The more traders and more candles that we can trap in the counter trend direction, the more power we're going to have in the trade in the direction of the trend. And that's what we're looking to do here at RightLine. And we're looking to use all 4 of these indicators to point us in the right direction. Wait for a very, very successful pullback, right to support on a long, pullback to resistance on a short, and head up. And you'll see it works a very high percentage of the time. So, okay, guys and ladies, take care. Call us if you have any issues. Send us an email. We're going to be sending everyone in the webinar a taped copy of this webinar along with the special offers. You'll have PayPal buttons linked to buy these indicators, and they're only going to be $99 a piece. So everyone have a really great afternoon, and I really thank you all for coming. and giving us your time. So take care.